Welcome to the Elevate Market Chat. This episode is recorded February 20th, 2025. In this episode, Shane and I discuss the financial market response to the new presidency and sector rotation before getting into gold and inflation. Hope you enjoy the episode and thanks for tuning in. Shane, how's it going?
Kyle, I'm doing better than you sound, buddy. I know you've been under the weather a little bit, so it's good to have you back on your feet, at least getting back to feeling better today.
Thanks. Yeah, it's a bit of a recovery. We were out of the office last week having fun, and I think it just caught up with me. So, yeah, back to looking at the markets, getting some work done, and just excited to catch up here. I know we haven't had the biggest moves, but we've got a new president, and with that, a lot of excitement and questions. So, with that, let's go ahead and kick it off.
All right, man.
So, the first thing I was just looking general markets. I mentioned we haven't moved a ton, kind of been sideways, but I think after the run up that we've had, that's kind of expected. Anything you're kind of have on your radar or?
No, I mean, it's been a little boring to be honest, which is fine. I was just actually looking since you said that the market's only up 5.7, 5.5%, call it, since the day before the election. So, I mean, it's not down and it's not flat, but it's not up a whole lot either. And I'm telling you, I feel like if you ask most people, well, how much the market's up since the election, they're going to tell you, oh, the market's just been crushing it and ripping since the election. That's the sentiment that I feel like is out there, and maybe I don't have a good pulse on it. Maybe I've watched too much CNBC lately. I don't know. I'm kidding, by the way. I haven't had any CNBC on. But the perma bulls out there, I feel like they have the narrative locked up, and really, market hasn't done a whole lot of anything. And there was a point, I guess, in January where the market was actually, just barely flat. It was down 0.16% on January 13th, from the day before the election. So, I don't know. I guess there's a little bit of volatility, but nothing too crazy. It's just it's a little boring, especially given all the headlines that we see out of Washington. And I will also say that it's a lot of fun to have Trump back in the office from a trading standpoint, because the man just he creates headlines that move the market. I think he does it mostly intentionally, and I think his playbook is fairly predictable. Um, we've seen it happen so many times, and what happened most recently was these tariffs on China and Canada, where he threatened to put max pressure, 25% tariffs on everything, and then they were in place for about 30 seconds before he said, "Nah, we'll give you a 30-day exemption." And of course, the markets rallied on that, and so that's kind of his signature move that he does is asks for the world and makes really big, bold claims and then walks them way, way, way back. And we've seen this happen, repeatedly through his first presidency. So, not surprised that we're seeing more of that. I'm sure there will be more to come, and just be on the lookout for that. I guess next time that there's a big headline, some type of big threat. Um, look for that to be scaled back down the road. So you don't want to trade the initial move. You want to trade the later walked back move, I think.
Yeah, and I think that's a great way to look at it. We had those tariff threats come out, and yeah, it's just part of a negotiation. And as you recall from his first presidency, him being on Twitter, and just anything else he would say on the news outlets, the market would just move so much. And here we are, we just had this nice run up last year. There's going to be some consolidation, little volatility, and that's all this is. I was just looking at it. If you look at the SPY, so that's just maybe a good measure to look at the S&P 500 for what people might actually trade. We've hit resistance 3 times around that 610 level, but it's just kind of taking a breather. I think that's totally normal, but with volatility at a relative low, still some volatility, as you know. Just looking at sectors, I think we saw or tech, which Nvidia is the big name there, had this big run up, but sector rotation might start to come into play now, right? So maybe it's, I know, like energy, a lot of talk around that. Any sector standing out to you?
No, but I'll tell you, I guess backing up one step, you mentioned the technicals in the S&P 500, which I wrote about in our commentary. I'm going to try and keep an eye on the technicals, just brief high-level technicals in each of my monthly commentaries. But I told you I thought most traders would probably be shorting these double, triple tops until we actually got a breakthrough. Market tried to break out. It did close at a new all-time high yesterday, but has now pulled back kind of below that level. And to me, it just looks like that 200-day moving average is really calling the market and really wanting it to come back down, which is only like a 7% drop from here. So it's not like the end of the world if the market pulls back to the 200-day. I'm not calling for a bear market or a crash or anything like that. I think that would just be pretty normal. So I'm still looking for that to happen unless we get like a real breakout to a new all-time high that holds, which, hey, that's possible. And as we were talking about before the call, what you need to do is prepare for a wide range of outcomes. We're not here to predict the future. We're here to be ready to make the appropriate move regardless of which way the market goes. So just wanted to comment on that before I answer your other question about the sectors. And I think that you sort of mentioned it, but within technology, there's another sector called semiconductors, which is what NVIDIA is, another large component of. And the semiconductors have really underperformed relative to the market for quite a while now. I mean, I think we're talking about, I was looking at a chart of this the other day, but I think since probably around July of last year. I mean, okay, so if I look at the semiconductor index, it closed at a high of, call it 281 back in July of 2024. And it's currently just where we're trading today is down 8.5% since July. Meanwhile, the S&P 500 is since July's high is up 8%. So that is a big time divergence for what was supposed to be leading the market higher. And so I have my attention there for sure. Either that will eventually bring the market down, um, or semiconductors probably have to play a little bit of catch up there if the market's going to continue rising. So I think, I mean, and what you said is true, right? Obviously, somebody's rotating. Many somebodies are rotating into a new sector from the semiconductor index, or from the semiconductor sector. But at the same time, I think when those that market leadership changes, it should capture your attention. And I'm just surprised at how long that has continued for. So I think that's interesting.
I am too, and you hit that pretty spot on. Tech, if you look like the XLK, so that's just the ETF for that,
Hmm.
it's going up near new highs, but NVIDIA or the SMH, so SMH is the ETF for the semiconductors, really nothing has happened since last June. So to be expected after that huge run it had. But that's, I think, what a lot of people look at too, and they say, hey, the market's overvalued and we've gone too far. Some of them kind of get stuck on that one sector of all the hype around NVIDIA. And, now that money, it just might shift to a different sector. And that's kind of where you always need to be a participant in the market, is that oftentimes there's still a sector or even individual names that will be positive and looking good.
Yeah.
So,
Uh, I don't
Shane,
have anything to add to that. I think that's a nice wrap up there.
perfect. Um, so then just looking at the sectors where it stands right now, quick summary. And for those listening, if you ever want to go look at this, you can go to barchart.com and look at market performance. But yeah, just a couple ones that stood out to me, I think, is, well, what sectors are leading? Utilities, oddly enough, financials. So not the names, I haven't heard those talked about with such hype. But then those that are not doing so good is like materials, real estate. And that's just a good area to go look in when we're talking about these sectors about performance. Just a nice, easy way to go look at that. So, but Shane, you mentioned in your commentary one really strong outperformer, and it's not a stock, but it's a commodity, and that's gold. Um, What are you seeing on that?
Well, I'll tell you this, I think of gold more as a currency than a commodity because it's not really used for much of anything other than things like maybe the James Webb Space Telescope, which is pretty darn cool. But yeah, I think of gold as a currency. Because it's been money for thousands of years, and I think that will continue to be true for thousands more years, whether we have bitcoins or dollars or euros or yen, whatever. I just don't think gold's going away. No matter what anybody says or creates, gold is gonna gold, and it goes through periods of just absolute boredom and nothing and stays flat for a long time. What it doesn't really do is crash for extended periods of time. It pulls back and it goes down, and sure, you can find spots on the chart where gold fell by, I don't know, maybe 30% or something like that. But there's not any like 80 or 90% drawdowns in gold. So I think it's just a great store of value, and as long as as long as we're measuring the value of gold in terms of dollars, the more dollars that come into existence in the form of debt and deficit spending and inflation, the more of those dollars it's going to take to buy gold. So it's kind of built in that gold will rise in price over time, and that's exactly what it's done. Um, it's really taken off this year. It's up a lot more than the market this year. Gold's up 11.7, yeah, like 11 and a half, almost 12%. Oh gosh, 12.5% as of this morning. So that's just this year. And as I pointed out in my commentary, gold's up 40%, almost doubling the market return, almost doubling even the Nasdaq return over the past year. So it's like uh, you definitely want to have some exposure to gold. Um, there's lots of ways to do that. There's ETFs, there's physical gold, there's coins, there's jewelry, all types of ways to do it. We think we've got a pretty good way that we use in our strategies at Elevate. I'm not going to give away that ticker because it's a little bit thinly traded, but um, yeah, there's a really good way to do it if you want to own paper gold in the market, and because GLD and other gold ETFs, GLD being the biggest one by a long shot, they have they have some weird tax treatments to them. And without getting too much into the details on that, I'll just say that and put that out there. And I'm sure if you want to do the homework to figure out what would be a better way to own gold than the gold ETFs, um, I bet you could. I bet you could figure it out if you want to go hunt that down a little bit. And if not, if you want to just call us, we do manage money for a living, and so call Kyle, and maybe he'll give you the secret sauce or do it for you. But anyway, I think maintaining some exposure to gold. I love royalty stocks as well. So I'll say that gold royal, not gold miners, right? But gold royalty stocks. Just looking at the big one is Franco Nevada. They're worth like a few $1 billion per employee. It's basically an accountant, a geologist, and an attorney. And the company's worth, gosh, I don't know how many $1 billion at this point, but I think last time I looked, they had 45 employees and their current market cap is $27 billion. So the market cap per employee is like pretty crazy. So gold royalty stocks are a great way to play that. And to be totally honest, I wouldn't say that you're too late, you know. Um, there's a lot of momentum behind the gold trade right now. I think there's a lot of really good fundamental reasons why gold could continue to rally. I said the same thing in my commentary back in June, and since then, I mean, just go look at a chart. It was already up a lot in June of last year, and all it's done is go up more. So if we keep doing what we're doing as a country and spending what we're spending as a country, um, there's just no reason. Like, I won't be surprised if I wake up 6 or 8 or 12 months from now and gold is $4,000 an ounce. Like, I'm not predicting that that's what will happen, by the way. So don't get me the wrong way. But today, an ounce of gold in the futures market is 2,951. So call it $3,000. And I'm saying I won't be surprised if in a year or less that's $4,000 an ounce. Um, I also won't be totally surprised if it's like, say, 2,500 an ounce. So I think there's a wide range of potential outcomes there that you should be prepared for. But we hold gold as, we call it a chaos hedge. It's a hedge against chaos. It's the port in the storm. It is like, if you're a fan of the movie Inception, it's the totem. It's the thing you bring with you into the dream world that is, stock markets, that gives you a reminder of what reality is like. And so we love gold as a hedge against chaos. We love gold as a measuring stick, against other things. Like, you can measure the S&P 500 in gold, right? How many ounces of gold would it have taken to buy the S&P 500 a year ago, or 10 years ago, or 20 years ago, compared to how many ounces of gold it would take to buy the S&P 500 index today? Well, it doesn't take rocket scientists to figure out that if gold was up twice as much, as the S&P 500 over the past year, it takes half as much gold to buy the S&P 500 as it did a year ago. And so it just gives you a measure of, like, how much of the S&P 500 or stock market return is from debasement of currency. Um, and I don't think that's a good thing in the long run. But you know, printing money and deficit spending and government spending will make stocks go up. It'll make lots of prices go up. That's why we've seen the inflation we've seen. So it is what it is, right? And that's the game we get to play. But we love gold for a lot of different reasons, and very glad to have uh, have been holding lots of it and not selling any. Haven't sold any gold in a long time.
And Shane, I just can't help but notice you keep using the words, exposure, chaos hedge. I don't hear you use the word investment. And with gold being the unique thing that is, a material, a currency, um, is it viewed more as just something in a portfolio to kind of help the overall diversification? Maybe it makes some good returns in periods, but it's not like owning, say, Netflix, where it generates cash flows and has growth and perpetuity. Is that what I'm hearing?
Yeah, I mean, I've heard it said that, and I think this is accurate. I think rather than gold being an investment, I think gold is a decision not to invest. Owning gold is a conscious decision to opt out of the investment game, which is highly manipulated, by you know the powers that be, that have their finger on the money printer. And gold is just something you can't print it, right? You got to do the work. You got to go find it. You got to dig it up. You got to create the mines. It's a choice to say, you know what, with this money, I'm not playing those manipulated stock market, futures market, whatever types of games. I'm gonna have this, and I know that it's going to maintain its value, right? I'm not buying it because it went up. Like, we didn't buy gold a year ago because we thought it would beat the S&P 500. That was never the point. That's just an added bonus, you know. And all that really does is tells you how much money got printed in order to make that market go up. And it's funny to think about it in terms of, like, okay, well, what would have happened if the market, if that money wasn't printed, if inflation wasn't as high as it was, what would have happened to the market? Probably would have crashed. And I think that, if you look at what the Fed did just in early 2023, when, more banks were failing than were failing during the Great Financial Crisis and the mortgage meltdown. If it wasn't for the Fed stepping in and guaranteeing all of these fixed income securities that were down 50% or more, we could have had a very, very serious catastrophe on our hands. And, people will say that, well, gosh, they had to step in and save the market. And I would say that, no, they shouldn't have. They should have let it fall. They should have let all those banks fail. Yes, a lot of people would have ended up unemployed. Yes, there would have been a major recession and the stock market would have crashed. All these things are true. But that's like it's the business cycle, man. It happens. And what happens when it's called moral hazard, right? When you're always getting bailed out of the bad decisions that you make. Um, like even back in the great financial crisis, nobody went to jail. No, none of the criminals at the top of the banks like went to prison or really paid any major fines. They just were bailed out by taxpayers and gave themselves bonuses and said, "Oh, we promise not to do that again." And then in 2023, what's happening? You know, they're all being irresponsible with other people's money again and nearly cause another financial catastrophe. And yeah, there's a limit to how many times the government can bail, you know, the markets out. I don't know what that limit is. We certainly don't appear to have reached it yet, but I just don't think it sets a good precedent for the future. And I would rather see the invisible hand of capitalism shepherding the economy than you know a small group of unelected officials at the Fed. I think it's ridiculous.
I would agree too. So, and that Fed, so their next meeting is March 19th. So, see what comes out of that one. But the big one is we just had an inflation print of 2.9%, the latest one. And you mentioned that in your commentary. And as you're speaking to with gold, there's cycles where it's gold as well. And inflation certainly helps that. How are you feeling about inflation right now, given the Fed has a target of 2%, which certainly is lower than 2.9?
Yeah, I'm actually trying to pull up the commentary to see what I wrote about it because I want to say the new number was not out when I wrote it. Yeah, that's right. It was when I wrote the commentary, the most recent one. I said the fourth consecutive month prices have increased at an accelerating rate. I don't think it's a coincidence that this aligns with the time frame in which the Fed was cutting interest rates. Um, and I mentioned that the Fed sort of acknowledged that inflation is still a problem. I'm just looking to see if I made any guesses about what would happen in the next one. And I just said I have my doubts about another rate cut, I guess. But ultimately, a couple days after I put this commentary out, the inflation, the CPI inflation number came out and showed that prices increased by 3% in January. Um, of course, that was the last month that Biden was responsible for the economy. Trump didn't take office until 20th of January, so we'll say that was the end of the Biden era. And I do think that maybe in the next few months the comparisons get a little bit tougher, and so maybe inflation will kind of plateau here, if not maybe even fall a little bit. Um, so we might resume a little bit of a disinflationary trend for a few months from here, but we're nowhere near the Fed's target 2%. And you know, from where I sit in the regular economy, just go Google egg prices or something like that. Everybody's talking about eggs. One of my buddies couldn't get eggs at any price from any of his local grocery stores about a week ago, and the farm that he orders them from was out. So eggs are hugely inflationary. I think somebody said they're up like 50% in a month or something like that. I don't know. It was crazy. I don't do the grocery shopping at my house, so I don't know, and I try not to look at how much eggs cost because we do eat a lot of them. But inflation's not going to be anywhere near the Fed's 2% objective anytime soon. And because of that, I don't expect them to be cutting rates anytime soon, despite Donald Trump's begging for them to do so. Um, so yeah, that's an interesting thing when you get the president coming out and saying interest rates should be lower, right? That's what he says, and then he says at the same time inflation is too high. It's like, well, those two things are irreconcilable, right? Those are irreconcilable differences and would break up a marriage because you can't have lower interest rates and lower inflation at the same time. It just doesn't work that way. So good luck on that aspect. And the longer end of the interest rate curve, like the 10-year and further out, is more influenced by supply and demand, which I've covered in my commentaries as well, not set by the Fed, or not even really heavily influenced by the Fed. But You say that the 10-year rate is more influenced by demand for buying those bonds versus supply of those bonds. And the rates just keep going up because the supply is too great for the demand. People don't want to commit money for 10 years at 5% because rates might go up a lot higher during that 10-year period. And that would make the 10-year bond at 5% worth a lot less if interest rates are suddenly 10%. So I don't know. I think rates will be higher for longer. I think that's partly what gold has been trying to tell us all along. And none of that means that the stock market has to crash, right? So some of this stuff might sound like I'm bearish. Well, fundamentally, there's not much good about our economy. We're just in so much debt, it's hard to even make any sense of. It's really hard to comprehend as a human being what $36 trillion of debt actually would look like.
Yeah.
I mean,
And,
it's crazy, dude. So,
and it's interesting on that. And I'm curious what your thought is here, but, we've got two things. We've got inflation, which inflation can be challenging to bring down, but you have, Doge. So Doge is out there and they're cost cutting as much as possible. But I'm just curious what you think in terms of what's more likely here, that we cut so many costs out of the budget that everything works out fine, or that we grow our way out. So, Trump's in office now and just brings these 4 years of prosperity, and now we grow our way out of it. I don't know. Any thoughts on which one of those might be most likely?
um, I would say zero chance of growing out of it. Zero. I'm absolutely certain that that will not happen. Certainly not in 4 years. But probably never at all. And I just think, yeah, and I don't think you can cut your way out of it either. I think there's only one way out of our debt situation, and that is inflation. I think they will print the dollars to pay it off, and we will see hyperinflation. I don't know when. I don't,
Hmm.
I wouldn't say that that will happen in the next 4 years, but it wouldn't surprise me if that starts because new Treasury Secretary Bessent said, we will not default on our debt. Well, the only way to pay these debts as they come due is to print the money to pay them off. There's we don't we don't have enough income. I mean, the federal government doesn't have anywhere near enough income to pay these debts off. Even if you wiped out the entire defense budget, just cancel all defense spending for the next 4 years, you still wouldn't have enough revenue from income taxes and other taxes to pay off these debts. There's definitely some talk of some unique things like if all the gold that we claim to have in Fort Knox is really still there, the government is actually carrying it at like a $40 an ounce value. And we just talked about how it's not worth $40 an ounce, it's worth $3,000 an ounce. So if you go revalue that gold, number one, assuming all the gold is really there, and you go revalue it at $3,000 an ounce versus $40 an ounce, you'll equalize, right, some of the net debt on the balance sheet. But it won't be $36 trillion worth. So I just don't see. We'll either default or we will default through inflation because I think that's just a technical default really in my world is if you print all the money you need to pay off all these debts and every dollar is worth that much less, it's pretty much the same impact as deciding to default, right?
Hmm.
Because the people who own our debt don't want to get paid back in monopoly money. So I think it'll basically be the same result. And I think the writing's on the wall. I'm not trying to be like Debbie Downer here, but that's pretty much what's happened to every other world reserve currency through the history of mankind. So to sit here and say like, oh, this time is different. The United States dollar is going to be the world reserve currency forever and always for the rest of time. I mean, it's just it's not likely. I don't think it's possible. Um, the timing on when all that stuff starts to come to fruition, I don't know, but I think we'll get plenty of indicators along the way that let us know that, the time has come to get more conservative and protect our capital. And, you would do that through a lot of different things, but gold is definitely one of the things you would want to own to protect yourself in the event of either a real actual default from the United States government or a technical default through inflation. Gold is and Bitcoin, but gold is definitely one of the things that you would want to own a lot of. And I also think capital efficient stocks would be another valuable place to be rather than US dollars. But for now, the dollar is rising, and it's kind of an upside down world. So despite all of these scary, awful economic fundamentals, you can see all that, and you can recognize it for what it is and still be very bullish on the stock market. So don't get me confused. Just because I see all this and I'm very concerned about our economy and our government's fiscal irresponsibility, doesn't mean we can't make a lot of money in the stock market if the stock market's going to keep going up. That's why we lean heavily on technical analysis when the fundamentals don't make much sense.
Yeah, that's pretty spot on there. I think right now it's the time where you can speculate on these, headlines that come across or the fundamentals that are out there. But meanwhile, while we are sitting here and we're not at a 20% drawdown in the markets, great time to form a plan and figure out what you're going to do if and when any of these, factors come into play. But I think right now it's just going to be pretty noisy. And after the market run we had, probably some sideways, and let's hope that inflation hangs out. But it's hard, like you said, with the eggs. I also have not seen eggs in our grocery stores for the last week or so. So
Really?
yeah,
Wow.
you're not the only one. So no pancakes at the Lotman household.
Oh man, that's tough. Yeah, I had oatmeal for breakfast the other day, so I wonder if maybe we're out of eggs too. I'm gonna have to ask my wife about that.
Perfect. Well, Shane, I think that's probably a good point to wrap it up. So thanks again for taking the time. And our next chat will be on the 20th of March. So until then, take care.
Thanks, Kyle. Have a good one. Hope you feel better, man.
You too. Thanks. Bye. Special thanks to our audio engineer, Stephen Crowley, for mixing this episode. This podcast expresses the views of Shane and I as the date indicated and are subject to change without notice. Elevate Capital Advisors has no duty or obligation to update information included. All information is for educational purposes only. Certain information concerning economic trends and performance is based on information from sources deemed to be reliable and has not been independently verified for accuracy. Wherever there exists potential for profit, there's also the risk of loss. This podcast may not be copied, reproduced, posted in whole or in part in any form without prior written consent from Elevate.